Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is just gone 10:30 UAE time, and welcome back to our first week of season 6 of the Daily Energy Markets podcast. Welcome back to some of our regular podcasters. Not seeing all the suntans and everything else here, guys. What's happened? You've been slaving away at the desks. Come on, Robin. I know you. You love the south of France. There must be something going on here. The sunbed maybe has not been turned on. Well, welcome back, everybody. Robin, let's kick off this morning thinking a little bit about OPEC Plus because, of course, they are due to meet this coming weekend, and they have been through a fairly accelerated supply increase cycle in the last few months, getting that 2.2 million back in the market. Not all of it tangible, actual barrels, but quotas nonetheless, the end of a certain round of cuts. Your thoughts on what the thinking might be with the reporting indicating that they might actually be thinking of going into a second round of increases when until recently the expectation was they were going to pause. Your thoughts about why they might be thinking about further increases?
Well, the natural thing to do would be to pause. I think this, but as you say, Sean, look, increasing kind of speculation and briefings, I guess that they're seriously considering another increase and starting to eat into the next tranche, the 1 barrels per day notional. Look, and I think this is if they do that, then the idea is okay, fine. The production increases so far have turned out okay. Prices haven't weakened much. Inventories not really building. The market has absorbed these barrels, and time to get them to the next phase of regaining market share. But pretty risky to do that going into the fourth quarter when every analysis out there, apart from OPEC Island perhaps, shows a period of oversupply.
Let's welcome back Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International in London this morning. Mark, oil prices are Brent trading about $67 a barrel at the moment, more or less where they were when OPEC Plus started its first round of supply increases in the last 6 months or so. They've added back 2.2 million barrels a day of quota. How do you think the market would react if they went into yet another phase of increases?
I think it would definitely be taken negatively, but I think what one has to look at is, are we underestimating global economic growth? There are a lot of headwinds, all of which, mostly are negative factors. So it's understandable that people think that, a further increase in supply against the putative demand outlook, is going to be a negative. But on the other hand, when one looks at particularly Asia, I think the Asian economies are faring a lot better. Yes, one can say it's good that they've a number of the significant ones have made trade deals with the US, so the headwinds from that are not so bad. But I think intra-Asian trade is growing quite strongly. And on that basis, I suspect that if we do get another increase, for the time being, without a genuine signal that you're going to see a lot more weakness in both the US and the Eurozone economies. The Eurozone economy isn't strong, don't get me wrong, but it's not also not in recession. So, for the time being, as long as that's the fact, I think any downturn probably still keeps us contained in this range, which we've
I
been
mean,
in.
time of year would be interesting going into sort of a more robust demand of the winter wouldn't seem to be a crazy idea.
No, it wouldn't. And simply on that basis, it probably will be better, particularly, as we know that the headwinds from the energy transition are not proving to be as strong as a lot of people thought. They will be over time, but at the moment, the downward pressure is not there.
Yuri Humber, founder and president of Japan Energy Platform, Yuri Group, sitting in Tokyo. Yuri, I'd like to just start with your thoughts, the optics of the events of the last few days in Beijing for a lot of talk about the Second World War and islands that weren't returned, and but a formidable presentation of the sort of other half of this emerging world geopolitical system. It's not BRICS exactly, but it's kind of BRICS. It's obviously China at the center, with showing fairly robust military muscle, with Russia, with obviously North Korea and other sort of neighbors of Japan. What does this all look like from Japan?
Thank you, Sean. Well, I think Japan's view is that probably that this isn't anything new. I mean, the scale of things, maybe the scale of the parade, all very impressive, I suppose. But these are the issues, if you like, the risks, whether militarily or economically, that Japan has been talking about for a long time. And it took a long time for Japan maybe to persuade its biggest defense partner, the US, that these are the risks that need to be considered, and maybe the economic ones too. And finally, the script flipped, if you like, with the first Trump presidency. And even though people expected it to kind of go back maybe once Democrats won the White House, but it didn't. However, with the second Trump administration, instead of maybe sort of taking it further in practicalities of building alliances, there has been, most of this year has been taken up by trade deals, as you mentioned. And now these trade deals are unclear. What is their status? The media in Japan is talking about the fact that maybe there aren't actually any pieces of papers to point to. Now, there's the court decisions in the US. There's comments from President Trump about whether maybe we need to roll everything back. And so while we're discussing all these trade deals and
are we discussing them? I mean, that's the problem, isn't it? The Japan trade negotiator Akazawa didn't go to US this week. We saw India very much part of the party in Beijing, supposedly a Western ally, supposedly an American, not quite the same security protections that Japan depends on, but nonetheless, should Japan not have been in Beijing?
Well, no, I think that wouldn't have worked for so many reasons. But in very brief terms, I mean, think about it. Most of the the geopolitical moves that Japan has taken, like the supporting of the Quad, like supporting of the various other trilaterals and so on with the US. Remember the first meeting of bilateral US, South Korea, and Japan, etc., which caused such a big signal at Camp David. Those were that was the trajectory, let's say, a year ago. And now, yes, Japan is discussing the trade deal because, instead of talking about further alliance building, there is only this as you mentioned, on-off negotiations about trades, about mega projects, and very little discussion about the geopolitical defense strategies.
So there's no move in a way that Europe is sort of rethinking its security paradigm with the US and up to 5% of GDP. Japan isn't looking to revisit its security position?
Japan has revisited its security position over recent years. The big move was already a couple of years ago with the publishing of its, a very big white paper on defense, which pretty much pointed the finger at China as sort of a very big threat and discussed it. And so that was sort of the rollout of the change in strategy, the doubling of the defense spending to 2% of GDP. But the problem is, it's all very well talking about percentages and numbers. Suddenly being able to move budgets to the level where you're doubling spending on defense, and then the Trump administration comes in and says, actually, 2% is not enough. We want 3% and maybe more. It's all very well talking about numbers, but somebody somehow has to pay for it. And I think the government has struggled to actually get to the point where they can marshal those budgets towards the defense. So I think that in Japan, the problem is on the practicalities.
Robin, looking at our own neighborhood here in the Gulf and to the geopolitical space, obviously some of the issues there in Asia, here rather unusual, but certainly significant statement out of the UAE overnight regarding Israel. Annexation of any part of the West Bank would be a red line and an end of the pursuit of regional integration. Of course, the UAE, famously signatories of the Abraham Accords. How significant a statement is that? Is this a departure? How do you see it and ramifications regionally?
Well, I see, this is in line with the position of Saudi Arabia, which of course isn't a signatory to the Abraham Accords yet, and the US has tried very hard to bring it in. Look, and I think the Saudis have used increasingly strong language over the past year or so on the subject of Israel as well. But yeah, I think it's an interesting signal from the UAE that would be a red line. What exactly a red line means? Does that mean you would guess, I would think, a suspension of the Abraham Accords rather than an actual exit of them. As a pause to economic relations and a downgrade of diplomatic relations, but not a breaking of diplomatic relations would be my guess. But look, I think that's because the US administration is not showing any inclination to restrain Israel, and the UAE and others increasingly concerned that Israel is taking more and more extreme actions, including the de facto annexation of the West Bank, even if not legally announced yet, and of course the continuing destruction in Gaza. So I think the UAE and Saudi Arabia are just getting increasingly at the end of their tether of how does this stop?
Mark, obviously one of the big stories in the energy markets recently, sort of dovetailing off the discussions about Asia and the Beijing conference, but is India's position. It's been one of the big importers of Russian oil over these recent years of Russia's war in Ukraine. The US has sort of finally arrived at this position of being rather cross about their sanctions violations of their violations of unilateral US sanctions, which of course are not necessarily globally binding, and India chooses not to adhere to them. This has now resulted in this somewhat public bust-off and very heavy tariffs on India. Now Modi looking like it's getting cozy to China. How do you see that playing out? Is this a big departure? Is it a bit of more window dressing? Does it have ramifications for markets?
There is a certain amount of significance. This pivot away from the West, or away from the US at least, is unusual. The improvement, or the attempt at some improvement in the relations with China, shouldn't be underestimated. I think where India sits in all of this is the realization that where are its primary interests, and as much as it's very much always domestically focused rather than internationally focused, it still relies on a lot of exports, and the US is a significant market, so it can't completely steer away. But there is clearly a pivot towards developing stronger relationships, not only with China, but I think across the whole of Asia. It's always had a strong relationship with Russia, so that's there's nothing significant there.
I suppose in some strange way, this sort of trifecta between India, Russia, and China, Russia being the supplier of oil, India and China being the buyers of this oil, the bulk of Russian oil exports going to those two countries. In a way, all that cooperation is bearish for oil markets because it's keeping the international oil flow going, which was more or less the blind eye that Biden was happy with. Is Trump faking it, or is he unhappy here? Is there a real American shift?
I sort of look at it in a slightly different way. I'm looking at it from all this speculation of, if there was a peace in Ukraine, which looks highly unlikely now, but that's by the by. People have been speculating, well, would Europe and the US basically start improving trade relations, above all energy supply relations with Russia? And the answer is probably not, simply because Russia is basically going to pivot now more and more strongly to Asia. So they don't really care whether there's a peace in Ukraine in terms of their potential buyers of their oil and gas. because they're looking at Asia and that's it. And that's, I think, probably the more significant part of it. And for markets, perhaps, the point is not that more Russian supply reaches Europe or the US or anywhere else, but that it's primarily now going to go more and more towards Asia.
Looking at the broken trade talks with Asia, with Japan, Yuri, to the extent in which they are, stumbling. Japan seemed to be very keen very quickly, and it's 6 months later hasn't really been able to sort anything out. Most recently, the demand for Japan to buy more rice from the US seems to be the snag. In the same way that with India, the Americans want the Indians to buy more dairy and agricultural products from the US. And of course, India cannot do that with so much of its economy and its population dependent on the domestic agricultural industry. What's the issue in Japan? Why is this a challenge for Japan to accept the US request for more rice buying?
Well, this is look, so the agricultural lobby is extremely strong and important to Japan because it also is one of the sort of the main supporters or one of the big supporters of the ruling LDP. There is also a very long history of Japan essentially using rice farming for many ways, not just for its own self-sufficiency. By the way, Japan's food self-sufficiency is one of the lowest of all OECD countries. So the idea that you would give up your key staple to any large extent is sort of anathema. Then there is also sort of the political angle, and there are a number of economic angles too. But the reality is that some of the arguments that are coming out from the US don't quite make sense. Again, just to not to deflect, but for example, on the cars, there seems to be this ongoing argument that Japan isn't importing US cars, as if there are actually any tariffs in place on US cars. There are none. The reason that Japanese consumers don't want to buy US cars is because if you've ever been in Japan, you've seen how narrow the roads are and you don't have big parking spaces. With a US vehicle, it's just not as practical, and most consumers are not interested in that kind of vehicle. Similarly, the rice, the Japanese people love domestic rice. They love to discuss the various varieties domestically. And so the idea that you could just supply a different rice and that would suddenly sell just as well, I don't think it works. So there's tons of these little issues that make it a very, very difficult, if not impossible thing for a Japanese prime minister to accept. And quite frankly, given the money at stake, it seems very strange that that's a big issue.
And despite all of these tariff headwinds, the Japanese economy continued to expand in the second quarter from the previous 3 months, outpacing forecasts. The Japanese economy is somewhat resilient to all of this, at least for now.
Well, I think maybe you'll remember the last time that we talked, there was one of the guests was very, very dour on the Japanese economy and talking about how the mid to long-term interest rates were spiking, et cetera, et cetera. And I said that, the economy is actually in a decent place and maybe some of those fears are overblown. Here we are. We have GDP, the latest numbers, 1% year on year annualized basis. Yes, for sure, some things will catch up, especially if the US slows down, as sometimes there are warning signs. But Japan is still led by the exports. The yen continues to be somewhat depressed, compared on a 5-year basis, if you like, because of the interest rates. But we'll see. There is some recent signs from the Bank of Japan that it may start again moving towards raising interest rates. So maybe some of that yen advantage is going to pare back.
Well, it looks like the dollar is fast following the yen's journey last year that the dollar is doing this year. Let's go to the survey question. here in terms of this OPEC Plus reporting, or the reporting about OPEC Plus, I should say. It's not OPEC Plus reporting, but Reuters, amongst others. How would oil markets react if OPEC Plus continued with a new set of oil supply increases when it meets this weekend? Of course, this is the last month, this month of September, that the final tranche of oil supply increases, 500,000 plus or so barrels for the 8 OPEC plus countries involved in this recent round of increases. This is the last tranche, bringing back that full 2.2 million barrels. There are, again, it all gets pretty complicated, another tranche of cuts that were done, if my memory serves me right, by a wider group than the 8 countries, but I myself am confused. Nonetheless, more oil from OPEC, if it was to come, what would the impact be on oil prices? Here's the options. Oil prices would rise. Oil prices would fall $2, oil prices would fall $5 and no change. And this is pretty much a kind of a question about the reaction on the day. This is to be announced on Sunday, and this is kind of a Monday morning reaction question, not sort of 6 weeks from now, but the immediate sense of reaction if OPEC Plus was to announce another increase on Sunday. Monday morning, oil prices would rise, they'd fall $2, they'd fall 5, there would be no change. Robin, question to you on this ultimately is there anybody with the OPEC Plus that can actually increase supply? I mean, all of these so-called cuts that were made, I don't know how many years ago by whatever number of endless countries within OPEC Plus, can any of them actually increase? Can any of them actually get back to those levels they were supposedly at a number of years ago? I mean, putting aside Saudi Arabia and maybe the UAE.
Yeah, look, I think that's the issue, Sean, and that's why I think if there is an increase announced, the market response will be pretty much a shrug. And I think because let's say they say we're going to bring back the 1.6 million over 12 months, which would be kind of a fairly aggressive schedule. So you'd be thinking, okay, well that's more than 100,000.
Especially if you consider that demand growth is only due forecast even by OPEC itself, I think 600,000-700,000 barrels next year.
Yeah. But of that 1.6 million, what you would actually get over the 12 months would be half of that, probably, because it would be Saudi, the UAE, Iraq, perhaps a little bit out of Kuwait, and that's pretty much it. So you'd be talking not 120,000 or so barrels per day each month, 60-odd thousand, from those 4, which is almost lost in the noise. And as you say, the others are maxing out. And as the increases go on, then Kuwait would max out too, and then at some point Iraq will hit its export capacity. So indeed, then you're back to the UAE and Saudi, and I think it's important that those two are really driving policy. They, and certainly the UAE has been pretty aggressive on wanting production increases and wanting increases in its target, knowing that it'll benefit, and increasingly the others will drop out of contention.
Mark, the other big factor impacting all the markets, it doesn't seem oil as of yet, but is the Fed pivot back to cutting rates. It seems fairly baked in now, despite inflation looking like it's got an upward momentum to it. The Fed is going to be cutting back to cutting rates next week or the week after, whenever their meeting in September is. Your thoughts on that decision, the likelihood it's the first of many or not, and what its ramifications for oil is. While all the other financial assets seem to be loving it, oil is not getting too much of ahead of itself. Your thoughts on the ramifications for the energy markets, and will they indeed move ahead with these rate rights?
Well, I've been of the view all year that we would get backloaded rate cuts in the US, potentially up to 3 25 basis point rate cuts before the end of the year, largely because of the impact of all that the Trump administration was always going to take a long time, and particularly on tariffs with all the vacillation, the backwards and forwards that had been going on, it was going to be a delayed impact, but it is starting to have an impact. In terms of the energy markets, the impact, to be honest, I think actually for markets broadly, I don't think actually there's going to be a lot of benefit. Um, the energy
Unless you
impact, I think,
own equities, US equities seem to be, I mean, they look at it for any excuse to go on another tear, but ultimately, the equity
oh,
markets seem to love it.
the equity market seems to love it because the bond market is basically a place that no one wants to go. I think that's primarily the issue. I think the oil market would be far more impacted, not specifically by the rate cuts, but what the impact would be on the dollar. And in those terms, actually, it could be a positive in terms of the dollar likely to go down, particularly if you get more and more political interference in Fed policy making, which is clearly on the cards and likely to remain the case. One thing I would stress in all of this is at some point we're all going to have to start thinking about midterm elections in the US, and Fed policy, trade policy is going to have to take a slight back step because the midterm elections are very, very significant. And at some point, all this uh, we worship Trump sort of attitude from other US politicians may have to change when they realize that, well, we could get hammered at the midterm elections. So that's going to increasingly be a factor, I think, as we go through the back end of this year and beginning of next year.
Yuri, let's just wrap up with where Japan is at the outlook for its LNG imports. Obviously, as we just said earlier, the economy is doing reasonably well despite the tariff headwinds with the United States. LNG, Japan being one of the world's largest importers for some time, even now an exporter of their excess LNG. What does the winter period look like from point of view of LNG imports and getting back perhaps to more long-term deals rather than spot? What is the picture from your perspective?
So Japan's always been a big believer in long-term contracts. Now, obviously, the trend with the market of recent years has been to move more towards spot. But the government here has always sort of not so much pressured companies, but has always tried to remind them that the long-term deals are sort of better for energy security. And now that energy security is absolutely back in vogue, not that it ever really went away in Japan, but it's maybe the number one priority by far today. Then long-term deals are following. As you may have seen, JERA.
And that security part, just to interrupt, sorry, there isn't really a great deal of storage capacity, though, is there? Where's Japan on that from the point of view of gas storage?
Long story short, Japan does not have underground gas storage like in Europe. It has very short LNG storage capacity, which is exactly and not very voluminous. So essentially, there isn't storage capacity, which is exactly why for Japan, the proximity of deliveries is so important. Why, for example, all of this talk about an Alaska LNG project and why Japan should be involved, it's really primarily the biggest selling point of that is really that, well, we could, deliver a cargo from Alaska potentially within sort of 8 to 9 days, which is extremely important, right, for Japan. But yes, absolutely, you're right. So there isn't much LNG storage. There isn't going to be any great amount of LNG or gas storage going forward for mainly geological and some other reasons. And so Japan has to, when it comes to energy security, its biggest card in the LNG market has always been diversification and sort of building up strong relationships with the countries, which is where sort of the Russia question comes up. As we discussed earlier, Russia does supply, I think, a little bit less than 10%, but around that of Japan's LNG. A lot of those countries, a lot of those Russian contracts, in fact, all of them are up for renewal in the next 5 years. And then there's also the matter of the currently sanctioned Arctic LNG 2 project, which, as you know, the first cargo has just been delivered to China. There's definitely a lot of interest in Japan to see, which, by the way, Japan is partly equity invested in that project, as is China, as is Total. And so there is a lot of interest to see how will the Trump administration react to this shadow fleet delivery to China. Are they going to do sanctions, which is what the Biden administration did, or not? And then from then on, obviously, Japan will need to think what it wants to do with its own LNG procurement strategy.
Well, we're going to have to wrap it up there. Oil prices would fall $2 is the main view in this room if indeed OPEC Plus continue with their supply increases into the fourth quarter. Today, of course, oil prices are already falling. Maybe it's that $2 has already started, down 50 cents in Asian trade this morning at 67.09. We'll leave it there. Again, thank you so much to the return of our great regular podcasters, Robin Mills, CEO of Camar Energy in Dubai, Mark Oswald in London, and Yuri Humber in Tokyo. We're all around the world in 30 minutes. Thank you, guys. Look forward to seeing you all soon again, maybe in Singapore next week for the APEC conference. All the best. Thank you.
Thank you.
Thank you.